Hello, welcome back to Fireside Chats, episode 2 with Become the Banker. I'm Jordan Quijano.
And I'm Joseph Quijano, Certified Financial Planner.
And we've got a great topic for you today. This is something that we've seen with a lot of our clients out there, and I personally have seen quite a bit of videos on it myself, which is velocity banking. What is it? What is the difference between velocity banking versus Become the Banker, and where can it apply to you and maybe not apply so much? That's what we want to cover in our second season with Fireside Chats, is topics that are going on right now in the financial arena or the financial world that maybe you're curious about, that you just don't know what it is or how to approach it. And that's what we're here for, is to give you this information, help guide you, and hopefully you can pick the right solution or right product for you.
You know, Jordan, you're absolutely right, because I have had several people call me to let me know that they really don't understand what the difference is between velocity banking and Become the Banker. And there is a great difference. I want you to know that there's a great difference. But I think people, consumers today, are totally confused, and they think that Become the Banker is velocity banking, and it's not.
You're right. So what is velocity banking? Let's start with that. This is a concept that has been around for some time, but it has actually been revamped, kind of almost remarketed under a different name. As most things change over the years, people get with better ideas, better marketing strategies, and that's what's happened with velocity banking. It deals with borrowing money and using that money to help pay down your debts and start paying yourself back. And that has some similarities with the Become the Banker, but the way to look at it is, it's like a HELOC. You borrow money from the bank, whether you're taking a lien or a loan against your mortgage, or if you're taking against credit cards, just any money that you're tapping into, but having a typically high interest rate, and a compound interest rate at that, is where you're at risk. A lot of these loans are variable loans, variable interest rates, and they can go up. But what I do like about the velocity banking is it helps individuals who maybe don't have a lot of money set aside to start paying off some of these debts. And that is one advantage, is if they've got a lot of equity in their house and they do it properly with not too much exposure, then they can really get ahead and pay their mortgages off sooner, and again, pay off credit cards, vehicles, and pay themselves back. Now, one important area though that's very different, and this is what I want my father to touch on, is the difference between borrowing money from financial institutions or borrowing money from yourself from the Become the Banker program and being able to pay yourself back instead of giving the money to financial institutions.
So the difference between borrowing from a financial institution like a mortgage company or a bank or a credit card versus the Become the Banker strategy is like night and day. When you borrow to get a mortgage, the mortgage company, the financial institution, will charge you compound interest. When you borrow on a credit card, you will be paying compound interest. When you borrow on just any loan from a dealership to get a car, you're paying compound interest.
So true.
So this is why, I don't know if you folks watching the video have any credit card debt, but I mean, if you get credit card debt, you get statements every single month as to the balances that you have. And on each statement, read them next time, you will see a disclaimer saying that if you pay only the minimum payment on that balance, you will be out of debt in about 10 or 15 years. I mean, that was a disclaimer that by law they have to put on there because people did not understand the difference between compound interest and simple interest. Now, on the other hand, when you borrow from the Become the Banker strategy, you're actually borrowing at a simple interest.
Right.
That means that you only pay on a declining balance. Let me give you an example. If you were to borrow $1,000 from the Become the Banker strategy, and the company would charge you 5% simple interest, you would only pay $50 once a year. Not every month. It doesn't compound every month. Once a year on a declining balance. So when the balance goes down to $800, they will charge you only 5% on $800, which is $40 for the entire year. What a difference.
Right.
What a difference. And secondly, okay, one point I want to make, secondly, while you're borrowing money from your Become the Banker strategy, your pool of money is still there as if you never touched it.
Right.
Earning 4%, guaranteed, tax-free plus dividends on the entire amount.
And I'll jump on that because I think that's important to talk about in more depth. So that point you're bringing up is very crucial. That's a huge difference. Not only is it the simple interest versus compound interest, not only is it the risk of having a variable interest rate that can go up, but just like you mentioned, the key difference is where does the money go and what do you get back in return? When you're paying on any credit card, any mortgage, whether it's through the Velocity Banking or just regular banking, you know once you pay that off or as you make those monthly payments, that interest is gone forever. It's never making you money again. It's never working for you again. So that is a key difference. Where they Become the Banker, you pay yourself back. You're able to really give yourself that extra interest back into your pocket that not only you get to keep, but it's always going to continue to work for you for the rest of your life so that you have that money set aside for retirement. That right there, ladies and gentlemen, is a huge point to make. You either pay yourself that interest or you lose it to the bank. Which would you rather have?
So I guess my question to you would be, what would you prefer to pay? Compound interest on Velocity Banking or simple interest with a Become the Banker strategy? I mean, the answer should be pretty clear. Simple interest is the key to building wealth. People should make compound interest on your money, investing your money, but when you're borrowing money, you should pay only simple interest. Now, the Become the Banker strategy, in addition to having simple interest, it has many benefits. It has a tax-free rate of return, a guaranteed rate, nothing to do with the stock market, so you'll never lose any money. And guess what? You have not only a death benefit, but you also have long-term care protection, which I believe is the biggest risk facing the American families today.
So looking at both products, again, right, wrong, and different, both products have their advantages. Both products have their disadvantages. And I think ultimately you got to figure out what is the goal that you're looking for. Keeping your money, earning interest for you for the rest of your life, paying yourself the interest instead of giving it away, and having some other added benefits as tax-free, death benefit. And at the end, both solutions do get you in the direction of getting out of debt, which we are all about at Become the Banker. Paying off your debts to be debt-free as soon as you can. So I ask you the question, you pick, you decide, you figure out, but more so, research. Do the research, ask the questions. It's okay to test both of them and ask the right questions so you can find the right product that fits your needs.
Thank you for watching this video with us tonight. We want to welcome you for the next video. So I'd like to just share with you that we want you to please subscribe to our channel, like our channel, and hit the notification bell so you will be notified when the next video will come out.
And keep in mind, we're a family-owned financial planning firm. We've been in business for over 50 years, and we encourage you, leave your comments, do the research, and again, reach out to us if you have any questions, and we can help you and your family get ahead financially in today's economy and protect you for tomorrow's. I want to thank you all, and we'll see you on the next one.